Hi guys, welcome to the very first session. Now, I really hope that you are as excited to start this with me as I am to start this with you. Before we dive into the actual course on this FAR subject, I want you to take some time out and just go back to the basics. So, in this very short session, what we are going to do is we are going to revise the fundamental aspects on which accounting is built, right? Because, if we have to build a house, the foundation needs to be very, very strong. So that's what we are going to do, guys, coming your way. All right. Now, one more thing, guys, one more thing. In all my sessions, I don't want it to be a very boring kind of a session wherein I speak, you just listen, you are on your phones while listening to it, and all sorts of things. That's not going to happen. What we are going to do is let's make it a very, very interactive session. Now, I know your doubt. You might be wondering, come on, Ayush, how is this possible? I am just listening to you on my laptop or on my mobile, let's say, and I cannot see you. So, how can I make it interactive? Well, I'll tell you how. Throughout the course, I will be asking you a lot of questions, and I want you, and I expect you rather, to just frame the answers in your mind. That's how we'll make it very, very interactive session. Okay, guys, let's begin. So, before we dive into the actual accounting part, I want to ask you my very first question that, my dear friends, what is accounting? Well, what is accounting, guys? Now, some of you might be saying that's very easy. I've been reading about it since my academic days. Well, come on, answer it then. Well, you might be wanting to say that accounting is to record, right? To record the transactions. Fair enough. Fair enough. Fair enough. But my dear friends, I'll give you a very basic example. Let's say that you go to your office, you have a meeting with let's say the managing director. So let's take this example that you, my dear friend, you are working in Tesla. Oh wow, that's a dream job, isn't it? Okay, so let's say you are working in Tesla, and let's say on one fine day at 10 a.m. you have a meeting with the managing director in Tesla. Now, do you think this is the transaction that needs to be recorded? This is happening in a company. Do you need to record this and will you consider it accounting? No. So, when I say recording the transaction, what I actually mean is recording the financial aspects of it, right? Recording the financial aspects of it. Now, fair enough. Now we know what is accounting. Accounting is to record the financial transaction in any company. Now, my next question, guys, what is the end goal of accounting? You do the accounting, fair enough. There is a team sitting in your office known as the finance team, let's say. They are responsible to update the books of accounts with every financial transaction. But the question is why? What is the end result of this recording the transactions in the books of accounts? Think about it. You know it. You know the answer, guys. Some of you might be wanting to say, that's very easy. The end goal is to prepare the financial statements. To prepare the financial statements. Fair enough. That's bang on. Correct answer, guys. Now, you know my next question. What are financial statements? You are absolutely correct that accounting is to record the transaction. Fair enough. The end result is to prepare the set of financial statements. Fair enough. What are financial statements? So I'll be asking you two questions here. And one of the question is where a lot of students, a lot of candidates get confused. So just we'll have a note about it, okay? So, my next question to you, what are financial statements? Now, you might be wondering, well, this is getting easier with every question, right? Well, that's how the basic class is, right? Okay, so financial statements. Some of you might be saying it's easy. It is a set of statements. It is a set of statements showing showing what? Showing the operating performance, showing the operating performance, financial position. Well, going forward in our next session, we'll just dive into these terms, right? Because as of now, I'm just creating a base. I'm just explaining you the what do we say, the definition of it, right? So financial statements are a set of statements showing the operating performance. Now, what is operating performance? Which statement I'm talking about? We'll deal with this in the next session. Financial position and cash movement in a company, right? This is financial statements, right? So we are working for an accounting period. Let's say 1st January to 31st of December. That's one calendar year. Let's say this is my accounting period as well. Now, I am working for an entire year. The company is working for the entire year. Now, while working for this one accounting period, won't you want to know what is the performance that you have achieved while working so hard in this year? Right? So, uh, this is why we need financial statements. There are a lot of people out there who are actually interested in the how in actually how the company has performed in a period, right? So who are those people called? Who are those people who are actually interested in how the company is working? Right? We'll talk about that. So, how do we present what we have achieved so far in a particular accounting period? It is through financial statements, right? Now, my next question to you is, who prepares this financial statements? Who prepares the financial statements? Is it the management of the company or is it the auditor, right? So, who prepares the financial statements? Is it the management of the company or is it the auditor? Who do you think is responsible for preparing the financial statements? It is always the management, right? So auditors are not responsible for preparing the financial statements. It is always the management of the company who is responsible for preparing the financial statements. Now you might be wondering, then what does an auditor do? We'll talk about this in audit segment, but just remember that auditor is responsible to review the financial statements and conclude whether everything is going on fine or not in the company, whether there is some point of concern, right? So we'll talk about that in a separate segment. You have your audit exam. We'll talk about. But as of now, just remember that it is the management who's responsible for preparing the financial statements. Now, we also said that finance, we also said that, there are specific people out there. There are a lot of people out there who are actually interested in how my company is working. What are the results that I have achieved that I am reporting for a particular period? Who are those people? Those people are known as my stakeholders. All right. So the end goal of accounting is to prepare the financial statements. Yes, but for whom? For my stakeholders. Now, who are these stakeholders? That's one fancy term out there. Who is a stakeholder? So always remember, my dear friends, anyone, anyone who has an interest in the company, anyone who has an interest in the company is known as a stakeholder. Now you might be wanting to ask me, okay, then that means shareholders? Absolutely correct. Shareholders, they are absolutely interested in how the company is performing. Why? Dividends. Some of you might be wanting to say suppliers. Yes, suppliers are definitely interested. Why? Because if they are sending something to you, if they are selling something to you, they want to know whether you have the capacity to pay them back. Employees, salaries, bonuses, governments, taxes, banks for their loan repayments, potential investors who might invest in the company, customers, the management itself, etc. All those people who somehow are interested in the working of the company, yes, they are known as a stakeholder. Well, I hope this is clear, and I really hope, guys, I'm not moving too fast. If you feel that I'm moving too fast, please write it in the comment section and let me know. Okay, now that was a very, very basic fundamental to it. Now we discussed about accounting, right? We discussed about accounting. Now, whenever we are doing accounting, we are keeping in mind certain assumptions. So, accounting is built on certain assumptions. So, let's cover the accounting assumptions. Guys, yes, some of you might be wondering why I am not, just presenting a PPT, a slideshow in front of you, just everything written on the slide deck, and I am just speaking and reading out of the slides. I'll tell you why. Why not? Because my aim is for anyone who's watching this video. My aim is that after watching the video, everything should be crystal clear in your mind. And even if someone wakes you up at 3 a.m., right, from your deep sleep, deep and sound sleep, you should be able to reiterate everything that's being presented here. I want you to be perfect. I want you to have 100% result in the exam. Right? And I absolutely don't want to make it very boring by just presenting a slideshow and reading everything out of the slide. Right? So that's my style. And I hope you like it. All right. So accounting assumptions. So the very first assumption is going concern assumption. Well, I know that's your favorite and you are dying to answer it. We've been doing this since our academic days, and that's really one fancy word. Going concern assumption. Well, you know my question, guys. What is a going concern assumption? What do we mean by going concern? Well, I know you are dying to answer this. That Ayush, that's very easy. Let me answer it. Okay, guys, answer it in your mind, and let's see if your and mine understanding match. So, going concern means that entity will operate indefinitely, and I don't expect the entity to close down to be liquidated in the near future, right? So, what do we mean by a going concern assumption? Is that the entity will operate indefinitely and will not be liquidated. All right, that's my going concern assumption. That's the first accounting assumption that builds my me doing actually that builds me doing an accounting. That's the very fundamental of the accounting that we do in the company. That's the going concern assumption. The second assumption is economic entity assumption. Economic entity assumption. Now, what is this? This means, in very simple and layman terms, this means that your company is separate from owners. Your entity is a separate economic entity, right? So that is separate from the owners. This is the second assumption of accounting. Third is monetary unit assumption. Monetary unit assumption. What do we mean by monetary unit assumption? That all my accounting records are stated in units of money. All my accounting records are stated in units of money. Now, some of you might be wondering, what is that unit of money? Is there a standard unit of money? Do we need to present it in dollars? Do we need to present it Indian rupees? Do we need to present in any other currency? It might be euro, it might be pounds, it might be any other currency out there. So it depends. Wherever your company is situated, your accounts will be built in that currency itself, right? So it just means that there should be some monetary unit for under which you are accounting for the transaction, right? So all your accounting records that are stated in units of money. Fourth and final is your periodicity assumption. Periodicity assumption. Now, this means that, for every period, you are preparing the financial statements to know the operating performance, to know your financial position, right? So, for every period, you are specifically preparing the financial statements, right? So, these are my accounting assumptions. So you might expect a question in your FAR exam that which out of the following is not an accounting assumption, or which of the following is an accounting assumption, or which out of following is an assumption which means that the entity will operate indefinitely and will not be liquidated. So all these questions, you know the answers now, right? So these are my accounting assumptions. The next is your accounting principles. Now, these are certain assumptions which we consider while doing the accounting, but all the accounting work is done keeping in mind certain principles, right? So, what are those principles? So, let's cover some accounting principles. The first principle is historical cost principle. The first principle is historical cost principle. What does this mean? That, well, guys, as the name suggests, this means that all your transactions are recorded initially at cost. Why? Because that is the most objective determination of your fair value, right? So all your transactions are recorded initially at cost. Why? Because that is the most objective determination of fair value at that time, right? So if you are purchasing an asset, let's say today you purchase an asset and for let's say $10,000. So that $10,000 that you are preparing, that you are purchasing the asset at, isn't that the market value of the asset? Isn't that the fair value of the asset? Yes. So that cost is the most objective determination of fair value at that time, and hence all the transactions are initially recorded at cost, right? Second, full disclosure principle. Full disclosure principle. Now, as the name suggests, full disclosures. So, you remember we said that I am preparing the financial statements for my stakeholders? Yes. So, don't you think that anything which is useful for the stakeholders to understand the financial statements, any information that that could affect the decision making, that could affect the judgment of the stakeholders, should be disclosed in the financial statements? Correct? That's what it says. Full disclosure. So it says that financial statement users, or let me make it simple for you, that all important financial information that could affect the judgment of the users of financial statements should be disclosed, in the financial statements, right? That's your full disclosure. The third and a very, very important principle is your revenue recognition. When do you recognize the revenue? So, guys, we will have a separate video entirely dedicated to this concept of revenue recognition. Just understand that now we follow a five-step model, right? We generally now follow a five-step model for determining when to recognize revenue and at what amount, right? But now, as of now, in the principles part, just understand. I'll give you a situation and then you tell me. So my question to you is, let's say there is a company A. This company sells goods amounting to $1,200 to customer A, right? This customer A pays 1,200 in cash on the same day. Please let me know what is the amount of revenue that you will recognize. What do you think should be the revenue amount? Now, some of you might have already, framed the answer saying that a company sells goods worth 1200. The person gives cash, so the revenue is 1200. And you are absolutely correct, my dear friends. Absolutely correct. Now, let me add a little bit of complication. Let me add a little bit of complication to it. Same question. Company A sells goods to customer B this time, amounting to $1,500. Or let's keep the amount same for your understanding. Same question. Amounting to $1,200. Now, customer B will pay after 30 days. That means no payment has been made so far. What is the situation? On this date, the company sells goods worth $1,200 to customer B, and customer B will be paying after 30 days. The customer has not paid even a single penny on the date of sale. Please let me know the revenue that you are going to recognize. So you might have some answers. So there could be two answers that a lot of people out there watching the video might be getting confused. Some would be saying zero, and some would be saying it will be entirely 1200. So I'll tell you, zero is not the correct answer. Why? Why will you not recognize the revenue when you have sold the goods? Absolutely, you will. Are you entitled to recognize the revenue at this stage? Have you fulfilled your obligations? Yes. So you will recognize the revenue in entirety. We'll talk about what are the journal entries that we'll be making in the next video. So next video I'll be specifically dedicating to building journal entries only, right? So it will be again entirely 1200. So always remember something that I'm writing now. Always remember this, that revenue and gains, revenue and gains should be recognized. Revenue and gains should be recognized when A, it has been realized or it is still realizable, and it has been earned. So revenue and gains should be recognized. Now, what do we mean by this term, recognized? Recognized means I am entering this in my books. Books of what? Books of accounts, of course. When it has been realized, that means you have received cash. Realizable, that means you have still not received cash. And you have earned it. So let's talk about when it is realizable, when it is realized, and when it is earned. All right. So let's talk about realized as of now. Realized when goods or service have been exchanged for cash. right? When you have when you have when you gave the products and you received cash, that means you have realized it. Realizable. Realizable. When goods or services have been exchanged for assets that are readily converted into cash. That means receivables. Remember my second example? I haven't received any cash in this example, but still I am recognizing the revenue. Why? Because it is realizable. I will be creating a new current asset for me known as accounts receivable, right? So that's my realizable. And what about earned? What about earned? When the earning process is substantially complete. When the earning process is substantially complete and your entity is entitled to the benefits. All right, that's revenue recognition for you. At this stage, let's restrict ourselves to this much only, right? Of course, we'll have a full in-depth session on revenue recognition coming after some time for you. So there we will discuss the entire five-step module or five-step model which you have to follow to recognize the revenue. But as of now, that's what the revenue recognition principle says. The next principle is matching principle. The next principle is matching principle, which says expenses, which says expenses should be recognized in the same period as related revenues. Now, I'll explain this by an example. Take an example. Let's say this is Mr. A. Mr. A sold goods amounting to $1,000 to, let's say, Mr. B, right? Or goods or services, right? Don't get confused. Goods or services. Now, another question for you, and this is very, very important. Is this $1,000 my net income? Is this $1,000 my income? Yes or no? Absolutely no. Why? Because this $1,000 is only my revenue. I have received this money by selling the goods or services. Is this my income? No. Because now the principles say that to earn this $1,000 of revenue, you might have utilized some resources. You might have utilized your office building. You might have utilized uh, your staff. So, to arrive at the net income, you will have to bring in all the expenses also, which you have made, or which you have incurred to generate this $1,000 of revenue, right? So matching principle says if you are recognizing the revenue for a particular period, then you have to match it against the cost of the resources that you are using to earn that $1,000 of revenue. Let's say to earn this $1,000 of revenue here, you used your office building. The cost is rent. Let's say 100. You use electricity. Let's say 100. You hire two people. Cost of staff, let's say 300. So now what will remain would be your income on a broad basis, guys. Don't bring in taxation as of now. I know this is a very small and incomplete example of income. I know. So how we will expand this up, we'll talk about this in a separate video on financial statements, right? So as of now, just understand that matching principle says that if you are recognizing the revenue for a particular period, uh, you have to match this with the cost of the resources that you are using to earn this revenue. All right, these are your principles, right? So you have four principles: historical cost principle, full disclosure principle, revenue recognition principle, and matching principle. Guys, I hope it is absolutely clear till this point. I will not be moving forward in this video because I don't want to, or I don't want you to feel burdened while watching this video. So we'll keep all the videos short. All right. So I really hope you like the video, guys. If you really like it, please don't forget to like, subscribe to our channel, of course, and comment on the videos. And of course, please share this video and all our videos to anyone who you think would benefit. And as far as the teaching here is concerned, please let us know your feedback in the comment section, guys. Thank you so much for watching and giving me your time. I look forward to welcoming you back in the next video. Take care, guys.